Okay, welcome to TalkTickers. Let's dive right in. Today we're looking at Transcat, ticker TRNS.
Yep, they just reported their full year and Q4 results for fiscal 2025. We've been digging through the call.
Right. So let's start with the big picture numbers first. What jumped out?
Okay, so for the full year, consolidated revenue hit $278.4 million. That's up 7% over last year.
7%. Okay. And what about cash flow?
That was actually even stronger. Operating cash flow was a record $38.6 million. That's an 18% jump.
Wow, 18%. So cash growing quite a bit faster than revenue, always a good sign.
Exactly. Shows good operational control, you know.
And drilling down into the fourth quarter specifically.
Q4 revenue was $77.1 million. That's up 9% from the same quarter last year.
Okay, strong finish to the year then. And earnings per share.
Adjusted diluted EPS for the quarter came in at 64 cents.
Got it. So overall, the headline results, they paint a picture of, well, pretty consistent performance, wouldn't you say? Solid growth.
Yeah, I think that's fair. They seem to be executing pretty well, even with some of the macro stuff floating around.
Okay, let's peel that back a bit. Where did the growth actually come from? It wasn't just one area, right?
Well, both segments chipped in. For the full year, service revenue grew 7%, came in at $181.4 million.
And that service growth, that's mostly the core calibration business.
Primarily, yeah. That's their bread and butter, the really resilient part they always talk about. You know, recurring revenue and regulated industries.
Right. And then distribution.
Distribution was actually up a little more for the full year, 8%. That hit $97 million.
And what was driving that?
The big factor there, and it seems increasingly important, is their rental platform. Strength in rentals.
Interesting. But the mix was a bit different in Q4 itself.
Yeah, a bit. Service revenue growth actually accelerated in Q4. It was up 11%, double digits. Now, that did get a boost from acquisitions they made.
Okay, makes sense. And distribution in Q4.
A bit slower in Q4, up 4%. But again, the rentals piece was the leader there.
Okay, so that covers the top line. Let's talk about profitability, gross profit.
Right. Full year consolidated gross profit was $89.5 million. Also up 7%, tracking revenue.
But the margin itself, I saw that dipped slightly.
Yeah, the consolidated gross margin was down just a hair, like 20 basis points year over year, landed at 32.1%.
Any color on why?
Well, it's kind of a tale of two segments again. What's really interesting is that the service segment gross margin expanded in Q4 by 50 basis points.
Oh, okay. So strength there.
Yeah, hit 36.2%. And management pointed to, the natural leverage in that service model, plus gains they're getting from automation and process improvements.
Right, we'll come back to automation. What about distribution margin?
That was down in Q4, but actually up slightly for the full year. And again, that benefit came from the higher margin rental channel.
So rentals are really helping the margin mix in distribution.
Exactly. They even sort of hinted that if rentals keep growing as a share of the mix, distribution margins could potentially push up over 30%.
Wow, that'd be quite a shift.
Definitely something to watch.
Okay, bottom line, net income.
Net income for the full year was up 6%, hit $14.5 million.
And adjusted EBITDA. That's a metric they focus on, right?
Yeah, they see it as a key measure of operating performance.
Yeah.
That was up a solid 9% in Q4 to $12.7 million.
Okay.
And that pushed the full year adjusted EBITDA up 3%. Again, really driven by that core calibration strength.
Got it. And the balance sheet, how's that looking after the year?
Looks really solid. They ended the year with net debt of only $31 million.
$31 million, that sounds pretty low.
It is. It results in a leverage ratio of just 0.7 times. Yeah. Super low.
Yeah, less than 1 times EBITDA.
Right. And they also have $49 million available on their credit facility. So lots of dry powder, lots of flexibility.
Flexibility likely for M&A, I'd guess. They did a big deal recently.
Exactly. The Martin Calibration deal back in December, that was a big one for them.
How big?
Largest in their history, apparently. Brought in over $25 million in revenue, mostly service revenue, too.
And strategically, what did that do for them?
Oh, it hit a lot of targets. Big geographic expansion. Got them into the Midwest, Minneapolis, Chicago. Expanded their capabilities, particularly in dimensional and mechanical calibration.
Okay.
And it gave them bolt-on opportunities in places they already were, like Southern California and Phoenix. Plus, they said the integration's actually running ahead of schedule.
Good news. So they keep stressing the resilience of that core calibration business. Why is it so durable?
It really comes down to the markets they serve, right?
Yeah.
Highly regulated stuff, pharma, aerospace, energy, utilities. Calibration isn't really optional there.
It's mandatory, compliance, safety.
Exactly. So that creates these, really valuable recurring revenue streams It's less cyclical than some other industrial businesses.
But they did acknowledge some bumps, some
Yeah.
macro impact.
Yeah, they mentioned some short-term volatility. Use the term customer pushouts, which basically means projects getting delayed or deferred. But they sounded pretty confident about getting back to high single-digit organic growth in services once things, normalize a bit.
Yeah.
They see a healthy pipeline building for the second half of this year.
Interesting. Now back to distribution and those rentals. Usually you'd think rentals would pick up when companies get cautious about big capital spending, right?
That's the typical dynamic, yeah. Uncertainty often pushes people to rent rather than buy.
But that's not quite what they're seeing, or at least not the whole story.
This is where it got a little nuanced. Management kind of speculated that the current steadiness, maybe even strength in distribution, might actually be influenced by something else.
Like what?
Tariffs. The idea is that some customers might be ordering equipment now to get ahead of potential future tariffs, rather than it being purely a reaction to macro pressures pushing them towards rentals immediately.
Huh. So the usual signal from distribution is it a leading indicator of caution that might be getting kind of scrambled by these tariff worries right now.
Exactly. It means you can't just look at the distribution number and say, oh, things must be fine, or, oh, people are cautious. It's more complicated at the moment. You need to consider those external factors.
Fascinating. What about their solutions business? Used to be called NXA, right? How's that going?
Yeah, they're still working on that. Sounds like they addressed some earlier issues, and now the focus is really on integrating it properly, getting the Transcat sales playbook and operational processes embedded.
So stabilize first, then grow.
That seems to be the plan. Stabilize, then have it contribute to the overall organic service growth targets. But they also kind of frame it strategically.
How so?
They view it as a means to an end. It's often the way they get into a new customer relationship, which then ideally leads to discussions about their core calibration services. Their internal saying is apparently all roads lead to calibration.
Okay. Makes sense. Now, automation, you mentioned that helping service margins. How far along are they with that?
They use a baseball analogy. Said they're maybe around the fourth inning.
Fourth inning. So progress made, but still a long way to go.
Yeah, exactly. Sounds like it's a pretty involved process, not just the tech side, the coding, but actually rolling it out consistently across all, 33 labs and getting everyone using it properly.
Sounds challenging.
They described it as arduous, but obviously see it as crucial for long-term efficiency and margin improvement. Lots of potential gains still there as they head towards the later innings.
And cost control. Did they talk about managing expenses?
Yeah, they highlighted some good control on the operating expense side, managed costs carefully, including being selective about delaying some hires.
But they expect expenses to tick up a bit next year.
Some nominal increases, yeah.
Yeah.
Things like performance-based incentives might come back to more normal levels if they hit their targets in fiscal 26. But the message was still that cost consciousness is, a key focus.
Looking ahead then, what are they guiding for capital spending in fiscal 26?
Net CapEx, they expect it to be in the range of $14 to $16 million.
And that's going towards?
Mostly focused on boosting service capabilities, buying more rental assets for the distribution side, and investing in technology, which includes that ongoing automation work.
Okay. So overall vibe from management, optimistic.
Seemed pretty upbeat, yeah. Expressed confidence in the leadership team, highlighted that active M&A pipeline. They clearly believe there's still a lot of opportunity to consolidate the fragmented calibration market, even with more private equity players around.
Right. So let's try and summarize. What does this all mean for you, the listener, if you're tracking Transcat or this space?
Well, I think you see a company that's executing its strategy pretty effectively. They're integrating a major acquisition, Martin, seemingly well. They're driving real operational improvements with things like automation, which you can see feeding into those service margins, and they're generating strong cash flow.
And that core calibration business really does seem to provide a solid, resilient foundation, helps them weather some of these wider economic uncertainties or those customer pushouts they mentioned.
Definitely. Plus, that strong balance sheet, the low leverage, it really does suggest they have the firepower to keep doing strategic M&A. That's been a big part of their growth story, and they're signaling it still is.
And that whole discussion around distribution and tariffs, that's just a fascinating little insight, isn't it?
It really is. It shows how these big geopolitical things can sometimes mess with the usual business signals you look for. A good reminder to, look deeper than just the surface numbers sometimes in this environment.
Okay, time for our favorite disclaimer segment. This is not financial advice, but let's brainstorm a wild yet plausible trade idea just for fun.
All right. Well, given that super low leverage, 0.7x, right, and management explicitly saying they have a strong active M&A pipeline for accretive deals.
You could maybe build a case, purely hypothetically, of course, for going long Transcat, based on the idea that they announce another pretty significant acquisition in the next, say, 12 to 18 months, maybe something Martin-sized or similarly strategic.
Right. The thesis being they use that balance sheet capacity. The deal adds to earnings pretty quickly. It's accretive, and it further strengthens that core defensible service business, maybe in a new region or capability.
And the play is that the market, which might be focused on short-term noise right now, eventually wakes up and rewards that continued strategic execution and compounding growth more fully, betting on them pulling off another good deal.
Exactly. It's a bet on continued execution of that M&A playbook. But again, purely illustrative, just a thought experiment. Investing involves risk.
Absolutely. Always remember that.
Yeah.
So wrapping up our deep dive on Transcat's year-end, what's the final takeaway?
I think it's consistent growth, strong cash generation, successful M&A integration, clear progress on operational improvements like automation boosting margins, and a management team that sounds confident despite some near-term headwinds and those interesting tariff dynamics.
Yeah, they've built a solid model in those regulated markets and kept their financial house in order, which gives them options to keep growing, especially through acquisitions.
Seems like it.
Okay, well, remember everyone, this discussion was purely for educational purposes. It is definitely not financial advice. Please be aware that all investing carries risk.
We really hope this breakdown was useful, giving you some insight into Transcat's latest results and what might be driving things.
And hey, let us know what you think. Connect with us, tell us what other earnings calls or deep dives you'd be interested in hearing about next time.